Don't worry, I'll chop all this out. It won't be this awkward.
Okay.
It's a good thing we don't do these live.
1, 2,
Yeah.
3, 4.
All opinions expressed by Chris, Michael, Zach, and their castmates are solely their own opinions and do not reflect the opinion of 5i Research. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Employees of 5i Research may hold positions in the securities discussed in this podcast.
Welcome to the 10th episode of The Exponent with 5i Research. My name is Chris. I'm the head of research with 5i, and I want to welcome you, our listeners, to our journey into the heart of the Canadian markets. Our mission is to empower investors with precise insights and in-depth research into stocks, the economy, and more. With that said, let's dive into the Canadian and U.S. financial landscape. Today, I'm joined by my co-host, Michael. Welcome, Michael.
Thanks for having me.
Yeah, no problem. So it's been a while since we've last recorded an episode. I believe it was late last year in December. And so, 2025 has kind of started out with a bang. We had DeepSeek, the U.S. inauguration, tariff fears, hot inflation prints. The market's really been hit with a lot of news, and it's been able to navigate those fears well. As we're recording this, we're pretty close to all-time highs, if not at all-time highs. And so I've kind of been like figuring out my thoughts on the market and working out kind of what I'm seeing as the signal through all the noise. How do you feel about these markets, Michael?
So I think
just in general, yeah.
Yeah, just in general, I think it is a little bit like frothy, but like not all the sectors, all the names. If investors find high enough, they still find like great names to own. But it is certainly not as many as like 23, 24.
Yeah, no, it's a great point. We've seen like valuations expand since 23, 24. So that's always one thing that can kind of keep a lid on stocks and their momentum going forward. And we've seen really good positive back-to-back years in the market. So 23 and 24 were really strong years.
Right.
And we're continuing to hit new highs. And I think that the market can, likely continue hitting highs. But again, as we kind of mentioned, like it does seem like things are getting pretty elevated, and certain moves can kind of get exhausted eventually, as we see certain names just kind of rise and carry out some sort of like parabolic trend. So it's always a potential that we see some sort of deeper pullback, and 5% corrections definitely within territory for what we can see on an average year. And then 10% also is something that investors should not be surprised by with any given 1 to 2 year kind of period. With that kind of said, we'll dive into the segments that we have for today. So first section that we're going to be talking about is Canadian small cap names. So we'll start with you, Michael. What do you have for us today?
Sure. So I'm gonna talk about like a small cap, Canadian small cap name in the industrial space that I don't think many people pay attention to it enough. So the name of the company is Enterprise Group. The ticker is E. So the company operates as an equipment rental and construction services in Canada. So the business has been around for quite some time, but only started to like demonstrate some improvement in the fundamentals in recent quarters. So the company has like significant improvement in profitability and an acceleration in revenue growth in recent years. Like for example, EBIT margin improved from negative territory to around 24% in recent quarters, while revenue growth was around like 29% per year on average each in the last 3 years. And E is still trading at like 11 times 4 PE, but it is reinvesting heavily back into the business to grow. So not much free cash flow there yet. and management already shows some consistency in execution. The share price momentum is like off the chart. It's really solid. That being said, like one of the risks for E is investor need to be aware that this company operates in a cyclical industry, so things may not go up forever, and it is very likely that the company is currently in a favorable industry upturn cycle. So yeah, I think it's a pretty interesting name for investor to put on watch list.
Nice. Yeah. No, I like that a lot. And like the price momentum alone, the price chart, it looks great. The um, valuation expansion is good, and I like that. And especially that it's only at 11 times. So, that means that investors are valuing it a little bit more, and they feel that the company can continue to execute. So they're kind of valuing it at a higher premium, but still it's only at 11 times forward earnings. So still like pretty cheap. Um, the
Right.
EBIT margin, that's also nice and elevated and kind of staying up there over the past couple of years. And that revenue CAGR, the 3-year kind of chart is nice as well. It shows like it flipped from like a negative 3-year revenue CAGR to highly positive. So yeah, that's impressive to see.
And what's your
Awesome.
name, Chris?
Yeah. My name is D2L. So some investors may have heard of D2L before. The ticker is DTOL. So this is a Canadian-based learning tech company. They're aiming to transform education and workplace learning through tech. And the thesis is really to allow anyone, anywhere to access high quality learning. So anyone at any age, anywhere in the world can really kind of dive into their platform and access some sort of learning and some sort of educational content that they want. They have a few key products. One is called Brightspace. This is a cloud-based learning management system, LMS, designed for kindergarten to grade 12, higher education, and corporate training. And then the other segment is called Creator Plus. This basically streamlines online course creation. And then lastly, they have Performance Plus, which is an advanced analytics package that provides insight into learner performance. So really, this helps educators find who the at-risk students are and then helps them to improve on those outcomes. So D2L, it IPO'd in late 2021. So right at the peak of the bull market, where 2022, we kind of subsequently saw a lot of names decline. We saw a big decline in the tech market specifically. So D2L, its share price went through a bear market, but management continued to execute and grow the fundamentals. And it was such an uncertain market. D2L really didn't get the attention it otherwise could have in a bull market. And I feel like now we're kind of seeing that play out where its fundamentals have continued to grow, but it wasn't until investors really started to feel comfortable with taking risk that they started to notice this name. So in the top, we can see, its price performance trending up nicely and to the right over the past couple of years. In the middle is its gross profit and gross profit margin. So again, really nice, solid expansion there. That's exactly what we want to see with the margins too. Like they're at almost 70%. So really good, like kind of like a SaaS name. And then forward earnings is at about 26 times. So just a couple things I like here is, I really like that expansion in gross profits and gross profit margin alongside its expansion in valuation. And so a lot of people might be concerned by like overextension in valuation and forward PEs. And that's totally justified up to a certain level. But also within a certain range, I feel comfortable with that expansion just because that means that like investors are willing to pay a premium for this company because they see it executing on expansion, margin expansion, and therefore operational efficiencies and profit growth for the future. And that also means that analysts are likely raising their estimates and things like that, growth estimates for the future. So and a lot of the best companies that we see really in the stock market usually trade at a premium valuation. and they don't really come down unless something fundamentally or materially changes for the worse. So this rising PE is something that I like, in the sense that it means investors are finally beginning to like value it a little bit more. So yeah, so that's my name.
Oh yeah, I think it's a pretty interesting one. So we have it in like our growth model portfolio too. It's
Yeah,
done pretty well like since you added. Yeah, I like the fundamental too. It's like basically a software business, high margins,
yeah,
um, still trading at good multiples and growing like double digits every year organically. I just checked the balance sheet also has like 10% of market cap is in cash.
yeah,
So it's a pretty decent, solid name to own.
yeah, yeah, yeah. And I think they've done some share buybacks as well over the
Right.
last couple years, and I believe there's also a really small dividend, if I'm not mistaken. So yeah, they're looking to use some of that free cash flow towards, returning capital to shareholders. But who knows, with the cash, we could see either further buybacks or just protection in a bear market if we do see one in the coming years, or something for maybe a potential acquisition. Yeah, it's really hard to say, but yeah, it has a lot of positives for sure, I think, and definitely like the price momentum. So yeah. Okay, so the next section, we have two interesting ETFs that both Michael and I have come up with individually. So Michael, do you want to share your ETF that you're going to be discussing here?
Sure. Yeah, the ETF that I want to discuss today is the Aerospace and Defense ETF. The ticker is ITA. So aerospace is one of the niche U.S. industrial sectors that consistently rewarded shareholders with above average returns over the years due to its crucial role in like national security and international commerce. The industry is perceived by investor as like a high quality long-term outperformer that investors should have in their portfolio. And and the industry also has created some of the best performers in the public market, like over the years, like G Aerospace, Heiko, Ason Enterprise, and TransDigm, just to name a few. And the aerospace and defense sector has some favorable characteristics that created some of the most sustainable competitive advantages for incumbents in the industry. Like the first one is resilient and predictable demand. So the industry has enjoyed consistent government funding even during economic slowdown, and many aerospace companies also have a razor blade business model where these companies sell original equipment as a small markup and enjoy significant aftermarket content, which means like they sell spare parts and accessories for this equipment to function properly. And this is perceived as like highly recurring with high cross margins, software-like business model. Also really predictable in the industrial sectors. And the second competitive advantages these companies tend to have is like a very high barriers to entry. So complex regulatory approvals and certifications make it highly unlikely for new entrants to compete efficiently with these incumbents. Um, Also, it is really hard to get a new patent approved by the FAA, Federal Aviation Administration, uh, and due to like the safety standards. And so as a result, once a patent is obtained, the design for these aerospace parts is expected to be like standard for many years, if not decades. And so this creates substantial benefits for the incumbents to consistently raise prices year after year. So yeah, that's what I think is an interesting ETF to own.
Nice. Yeah, no, I like that. And it's It's an ETF with, a huge AUM and pretty reasonable MER, if I'm not mistaken. And like you were saying, yeah, government contracts, really predictable, and you can kind of like a lot of transparency. You can see into the transparency of like future potential revenues, and you can see the backlog, all that sort of stuff. And it's really helpful for shareholders and investors to kind of know when they're looking at that, and they can kind of see the predictability of the revenue model. And yeah, defense has really performed well over the years. I mean, the government, depending like U.S. and Canadian governments and global governments in general, just kind of allocate a decent amount of resources towards defense sector. So makes sense that yeah, we can definitely see some really solid revenue growth there, and potentially into the future. Yeah, no, it's a solid ETF, um, and yeah, I think it also helps with like downside protection as well. It seems like a name that I think in 2020 it did have a massive drawdown, a little bit more than the broader markets, but aside from that, it's had pretty nice, minimal volatility, so to speak. So yeah.
And Chris, what is the ETF on your end?
Yeah. The ETF that I came up with is the iShares US Tech Independence Focused ETF. So the ticker is IETC. And so what this ETF does is they provide investors with exposure to US tech companies that have a significant focus on sales and production, solely focused within the US. Um, so it's AUM. It has about just under $500 million in assets under management, 120 holdings. So if we think about it relative to the NASDAQ 100, the QQQ, it has just 20 more holdings than that one. And then its expense ratio is 18 basis points, so 0.18%, fairly reasonable. And so kind of how I found this ETF was it's one of the few ETFs when I did a screener that's kind of outperformed the NASDAQ 100, the QQQ ETF, over the past several years. So when we look at this chart is really showing us the relative performance of IETC against the QQQ, the NASDAQ. And so we can see it's outperformed over the long term. I mean, most of that outperformance has come within the last couple of years, but we did see some outperformance as well going into it was 2020 and then into 2021 again. And so, and most recently, it's really been exploding higher against that, against the QQQ. And so kind of looking at its top 10 holdings, so we can see, Broadcom 13%, Amazon 8%, NVIDIA 8%, 7% for Microsoft. So like really it's fairly concentrated in those top 10 names, similar to the NASDAQ 100. But what's interesting is when we compare those holdings against the QQQ, it's actually very different in some of the weightings. And so, what I outlined here is like Broadcom, the ticker AVGO, IETC holds about 13% in that name, whereas the QQQs just hold 4%. So it's overweight by 9% there. The IETC ETF holds 6% in Palantir, whereas QQQs just hold 2%. IETC has a 4% position in CRM. QQQ has 0%. And then it's underweight in Apple. So IETC has just a 3% position, whereas the triple Qs have 9%. So it's underweight 6%. So what's really interesting is like, and if an investor kind of wants to get exposure to high quality tech names in the US, but somewhat underweighting the Mag 7 names, this is a really interesting option because it has a lot of those high quality tech names and some high growth stuff. But it's not solely concentrated with the Mag 7 names at the top 10. So I thought that was kind of interesting and a good way to play some of those higher strength names that we're seeing recently. So yeah, that was my name.
I don't know. I like the ideas of like these are mostly like very high quality names, and So but there's some difference in the allocation compared to like IETC with the QQQ. So there's some like alpha right there. And also, I think there's a huge trend right now in the US that the government is trying to bring back the technology industry, tech sector, chip sectors back to the US instead of outsourcing it to like Taiwan, China. Yeah, because of its importance to the country and the cutting edge technology, stuff like that. So I think yeah, it's a pretty good theme to follow.
Yeah. Yeah, no, definitely. Thanks for pointing that out. It's a really good point, and yeah, looking at the price performance and everything else, and the allocations, I thought it was really interesting, and particularly due to the theme, and the rising trend of kind of U.S. focused sort of production. So, yeah, no, it's one to keep an eye on, that's for sure. So the next section, I'm just going to talk briefly about a new weekly feature that I've been putting out. So it's called the TSX Weekly Wrap. So this is a new video series that I'm doing. So recently I've been posting this on Fridays. It's intended to just be a quick 3-minute sort of video, 3+ minute video showing, different economic data from that week, market movers on the Canadian side. One interesting stock that I kind of found that week, and then looking at the forward outlook for the next week, like what kind of news or economic headlines should we be looking forward to for the next week. So I thought that I would point that out to listeners and viewers of this podcast. So if you want, take a look at that. Let me know, if you have any thoughts, any suggestions. Let me know if you like that. Let me know if you want anything changed there. But yeah, definitely open ears on that. And yeah, let me know what you think of the new video series. With that said, just going to switch over to the next section. So now we're going to be looking at recent earnings. So it's been, we've had the earnings season kind of mostly passing. We still have some names coming up, but a large bulk of them have kind of been hitting over the past couple weeks. So Michael's going to go through some of the recent earnings here.
Sure. So the most recent earnings season already like passed. Majority of U.S. companies already reported earnings, and I saw like some of the biggest theme of the earnings season so far is the spending on artificial intelligence of large tech companies. So despite recent volatility from like DeepSeek and high inflation, the AI theme continues to gain like significant capital investment, especially from large companies. So like companies like Amazon, Google, Microsoft, they continue to invest heavily into capital expenditure to build AI infrastructure. For example, Amazon guides for 100 billion investment in capex in 2025. Google forecasted 75 billion. Microsoft and Meta guided for around 80 billion and 65 billion respectively. So these businesses used to be capital light, high growth businesses, but the stories have changed meaningfully in recent years due to the AI opportunity. So, and combining all of these investment, these big tech companies are expected to spend as much as like 320 billion on AI and data center built out in 2025. So really large dollar amount right there. And so what does that mean for investor? So except Meta, like most big tech share prices have been pretty much under pressure after significant rises in capex guidance, and the concerns are legitimate. So investors are worried like about the uncertainty of the return on those investments, the timeline of the payoff, whether these investments could create value for shareholders over time. That being said, although the investment is high, these companies are supposed to grow their AI business like significantly, which is a major growth driver over the next decade. Like for instance, Microsoft CFO mentioned that the AI related services grew triple digit in the last quarter alone. And also, Andy Jassy, the CEO of Amazon, mentioned in the earnings call that AI represents like the biggest opportunity since the cloud, and probably the biggest technology shift and opportunity since the internet. And he believes that shareholders will be happy medium to longer term if the company is pursuing this capital opportunity in AI. Yeah, but in the near term, the share price may experience some pressure uh, until they've proven like this investment are profitable.
Yeah. Yeah. No, it's a really interesting thing with the CapEx cycle where, you know, investing for the future is great, but it obviously involves some sort of immediate upfront kind of payment, and then the payoff is, you know, into the future. So that takes a bit of time. But one thing that I found really interesting was, yeah, this common theme where we heard from the mega cap tech names where they said, you know, the demand was exceeding their available capacity for AI, and also that they were even upping their capex spend into AI infrastructure. And this was like following the DeepSeek news. So it was really interesting where we had kind of this immediate panic from investors that DeepSeek was going to cause like major tech companies and founders to scale back their investments into AI infrastructure. But what we saw in the following weeks was pretty much the exact opposite of that, where they were basically saying like, we don't have enough capacity and we need to basically spend more on infrastructure and building this out. And it seems like no one is willing to give up the lead in building out this infrastructure in the event that in the event that that becomes some sort of material loss into the future on the AI front.
Yeah, yeah. The capex seem big, but like this is like global opportunity basically.
Yeah.
Yeah, and also this the CEOs also mentioned like they are capacity constrained on like in Q4. And they only invest when they see the demand, not like so.
Right.
Yeah, there may
Yeah.
not be that much excess capacity. Um, so yeah, longer term is still bullish on like
Mhm.
mega cap and stuff like that. Well,
Yeah. No, definitely. That's it's a really interesting trend, and it is like it does feel like this huge pivotal moment where AI is clearly, I think we're just at the early stages of it. Like it's just in its infancy, and we've already done so much with it, with, you know, chatbots and LLMs and other stuff like that, but it really feels like we still haven't really scratched the surface on it. I mean, we haven't really gotten into like robotics sort of you know, plays yet. We haven't gotten into other sort of use cases like AI agents. Like that's not, you know, at a large scale yet or anything like that. It's all kind of so far a little bit more like narrative driven with AI agents, and even robotics. We're seeing it for sure, and we're hearing about it in autonomous, you know, driving and robotics and stuff. But it really hasn't come into like mass scale or large scale kind of production or use cases yet, particularly for the consumer. So I do feel like, yeah, this is like definitely at the forefront still for the AI theme. And it does seem like, yeah, something that's a huge opportunity. Yeah, similar to the akin to the internet. It really feels like, yeah.
yeah, I agree. Yeah. The sky is the limit.
Yeah, pretty much. Yeah. And I mean, it's exponential growth with things like that. So yeah, it's I feel like it is going to get pretty crazy. All right. So this next section, we're gonna have a little pop quiz for Michael. So it's called Guess That Chart. So I'm gonna put up a chart on the screen that has no ticker, no name, and Michael's gonna have to guess what it is. So here we go. So it's pretty tough because it could be anything. Let's see. How do I want to narrow this down? So obviously, it's kind of had a parabolic rise in 2021. So that's one of the first clues is, alongside all of those names that saw a parabolic rise in 2021.
Any clues? Like,
Um,
yeah, it could be
okay.
anything. No.
All right.
Is
So
it US or
think
Canadian?
okay. So it's US. Think along the lines of innovation.
So probably Roku.
Close. So it's a
Go 5 or
it's actually an ETF.
so probably ARC ETF.
Yeah, it's ARC. Yeah.
ARC Innovation.
ARC Innovation. Yeah. So yeah, this is the chart of ARC. It is on a log scale, so it won't look as crazy as it would on a linear scale. But yeah, we can see this massive rise from, really the bottom 2016 up to 2021. I think that's like a 10x plus rise. And then this massive sort of like bubble popping sort of price action from 2022 and into the bottom of early 2023. It took a while to bottom. So, really throughout 2023 and 2024, it rose, but, really went from like around 30 up to 50, 55, like not too like pretty good, pretty solid, obviously, but not as parabolic as it once was. But we are really starting to see it rise significantly in the previous months and even weeks. So this is something that is interesting me just because of this huge momentum, and we're seeing a lot of those underlying names really start to see, kind of that basing bottom pattern from the last 2 years start to get resolved, and the ETF is kind of resolving higher. So I think that's something to definitely keep an eye on for market participants. Yeah.
Sure. Yeah, the momentum looks solid for sure. Started to gain right there.
Yeah.
Uh,
Yeah.
mm.
Yeah. Yeah. Who knows if this goes back to its all-time highs, but definitely liking the momentum at the very least. And some of those underlying names are seeing a lot of like fundamental growth, which is leading to price growth and seeing some forward estimates being revised higher. So those are always positive trends to see.
Yeah, sure. Yeah.
Yeah. Okay, cool. So that's all that we have for today. We hope you enjoyed this episode of our podcast and learned something new about the Canadian and US markets. If you want access to more exclusive content and insights, don't forget to visit our website at 5iresearch.ca and sign up for a free trial if you haven't already. You can find the link in the show notes below. And if you like this episode, please give us a thumbs up and subscribe to our channel for more updates. Thank you for listening, and see you next time.
3, 2, 1.